Hi everyone, in this video we'll be going over A-Level Accounting 2022 October-November paper 1-3. This is paper 1 which is of multiple choice. This paper consists of 30 questions and we're also given a time limit of 1 hour. So without any further delay, let's get started. Goods worth 1200 sent to a customer on a sale or return basis have not been recorded in the sales journal. Which accounting concept has been applied? Okay, we are basically talking about not recording the transaction as sales when we send goods to a customer on a sale or return basis. And this is obviously the realization concept, since we record this transaction as sales only when the customer acknowledges it as the goods they bought, right? And until then, we have to count those goods as part of our inventory. So the correct answer we are looking for is going to be the realization concept, which is given in option D. This concludes the first question. Let's move towards the second one. A business sold a non-current asset at a profit. What are the entries to be made in a disposal account? So disposal account is the ledger account, which consists of the debit side and the credit side, right? And the very first thing that we need to record in our disposal account is the cost of the asset that we are disposing. And that cost is always recorded on the debit side. So debit side consists of the non-current asset at the cost. Then the next thing that we need to record is the value that we utilize of the non-current asset, which will be recorded as our provision for depreciation and our sales proceeds. So the provision for depreciation is recorded on the credit side. And then the next thing is the sales proceeds. So that is basically the amount that we received when we sold that non-current asset. And that amount will be recorded in our bank, right? So we need to record it under the heading bank in our credit side in the disposal account. And the last thing that we need to record is the profit or loss on disposal. And in this case, we are told that we sold the non-current asset at a profit. And the profits are always recorded on the debit side in case of disposal account. And since we record this profit in our income statement, the heading under which it will be recorded in our disposal account is also going to be income statement. So these are the entries to be made in a disposal account. So these are the entries we are looking for. Let's look for the non-current asset at cost and our income statement. That is given in option B. And on the credit side, we have provision for depreciation and bank, which is what we require. So the correct answer for question number 2 will be B. This concludes the second question. Let's move towards the third one. On 1st January 2020, a business purchased new delivery vehicles. The following information is available. So we're given the total purchase cost of 300,000. The cost of painting delivery vehicles in the company's colors is 4,000. Now, the very important thing to do will be to categorize these costs as a capital expenditure or revenue expenditure. And capital expenditures are those expenditures that only occur once, right? And we're talking about painting the delivery vehicles. So once those vehicles have been painted, they do not need to be painted time and again. So we can categorize it as a non-recurring expense. So this is a part of the capital expenditure, right? And the next one we have is total annual maintenance costs. So these are the annual costs, which means that we need to repay it again in the next year. So these are revenue expenditure. All right. Then the company depreciates delivery vehicles using the reducing balance method at a rate of 40%. So this is the rate of depreciation, and we need to charge this rate to our net book value because we are depreciating it under the reducing balance method, right? And now we need to figure out the depreciation charge for the delivery vehicles for the year ended 31st December 2021. First of all, we need to figure out our cost. So let's do that. The total cost is just the total purchase cost of 300,000 plus all the capital expenditures associated with it. And in this case, that is only the cost of painting delivery vehicles, which amounted to 4,000. So the total cost of the delivery vehicle purchased at the date of 1st January 2020 is going to be 304,000. And we need to figure out the depreciation for the year ended 31st December 2021, which is the second year of that delivery vehicle, right? So first of all, we need to figure out the depreciation charge for the year ended 31st December 2020. And we know that we purchased the delivery vehicle this year, which means that there is no accumulated depreciation, right? So our net book value is just going to be equivalent to the cost, which is 304,000. And now we can charge our depreciation rate, which is given to be 40%. So we can write it down as 0.40. And this gives the depreciation for the year ended 31st December 2020 to have the value of 121,600. Now we move towards figuring out the depreciation for the year ended 31st December 2021. And in this case, our accumulated depreciation will be the depreciation for previous years, which is for the year 2020, right? So the net book value is going to be the cost of 304,000 minus the previous year's depreciation of 121,600. And now we can multiply it with the rate of 40%, which we can write down as 0.40. So this gives the depreciation charged for the delivery vehicles for the year ended 31st December 2021 to have the value of 72,960. This is the answer we're looking for, and its value is given in option B. This concludes the third question. Let's move towards the fourth one. The following information is available in respect of a trader's non-current assets. We're given the accumulated depreciation at 31st May 2020. We're given the depreciation charge for the year ended 31st May 2021 and the accumulated depreciation at 31st May 2021. Alright, now during the year ended 31st May 2021, a non-current asset which had cost 10,000 was sold. There was a loss on disposal of 1,200. We need to figure out the sale proceeds. Okay, we are told that there was a loss on disposal, right? And loss occurs when our net book value is greater than the sales proceeds. So the net book value minus the sales proceeds will be our loss. And in order to figure out the value for sales proceeds, we first need to figure out the net book value of the non-current asset that we disposed of. And in this case, we're given the cost to be 10,000. So we just need to figure out its accumulated depreciation. And remember, we are also given the accumulated depreciation's value at the date of 31st May 2020 and 31st May 2021. Now, I'm just going to write down the format for the statement of accumulated depreciation, right? We can start with our opening balance of the accumulated depreciation. Then if we add the depreciation charge for this year and subtract the accumulated depreciation of the disposed asset, we get our closing balance of the accumulated depreciation. And this statement of accumulated depreciation that I just wrote down is basically a vertical format of our provision for depreciation account, which is a ledger account. Now, we just need to figure out the accumulated depreciation of the disposed asset, right? So I'm just going to write down this statement in an equation format by substituting its value. So first we require our opening balance, which is at the beginning date given to be 31st May 2020, and it has the value 40,000. Then we need to add the depreciation charge for the year, current year, right? And it is given to be 9,000. Then we need to subtract the accumulated depreciation, which we are trying to figure out. And this gives our closing accumulated depreciation balance, which is given to be 46,000. Now we can easily figure out the value for accumulated depreciation of the disposed vehicle. That is just going to be 40,000 plus 9,000 minus 46,000. And this results in the value of 3,000. So this is the required accumulated depreciation of the disposed non-current asset. Now, we need to figure out our net book value, which is just the difference between cost and the accumulated depreciation. And in this case, we are given the cost to be 10,000. And we just figured out our accumulated depreciation to be 3,000. Which means that the net book value will be 7,000. Okay, now we can just substitute this value into our equation. So we're given the loss amount to be 1,200. We just figured out our net book value to be 7,000 minus the sales proceeds. Now the value for sales proceeds is just going to be 7,000 minus 1,200, which results in 5,800. This is the answer we're looking for, which is given in option A. This concludes question number 4. We can now move towards question number 5. Which error would result in an entry in the suspense account? The first one is a balance omitted when extracting the trial balance. Now what this means is when preparing the trial balance, we miss out a particular balance which would affect either the debit side or the credit side and result in the balance being different for each side, right? And that would definitely result in an entry in the suspense account. So this is the correct error that we are looking for. Then the second one is an item is posted to the correct side of the wrong account. And this is just the description for our error of commission, which does not affect the trial balance, which means that it would not result in an entry in the suspense account. So this is not what we're looking for. And the third one is entries for an item are reversed. And this is the error of entry reversal, which is again not reflected in our trial balance. So this error would not result in an entry in the suspense account. So this is not what we're looking for. The correct one is 1 only, which is given in option C. This concludes the fifth question. We can now move towards the sixth one. The balance of a purchase ledger control account was 7,270. However, the total of the accounts of trade payables was 6,860. The following errors have been discovered. Okay, when these errors were corrected, the balance on the purchase ledger control account still did not match the total of the accounts of trade payables. Now, we just need to figure out the updated amounts after the corrections, which means that we need to correct this balance of 7,270 for our purchase ledger control account and this balance of 6,860 for the accounts of trade payables. Let's start with the correction of our purchases ledger control account. So I'm just going to prepare it right here. This is the debit side and this is the credit side. And remember that whenever we're preparing the purchases ledger control account, our opening balance is always recorded on the credit side. So we just need to record this amount of 7,270 on the credit side. Now let's take a look at our error. The credit note received from a supplier for 100 had been omitted from the book of prime entry. And remember that our control account is based on those books of prime entry. So if we omitted this value of 100 in the prime entry, it also means that we omitted this value in our purchase ledger control account. So we need to enter it now. And this is the value for the credit note. So a credit note received from a supplier just means that the amount that we need to pay to the supplier has now been decreased by 100. And any decrement in the amount that we owe to the suppliers is to be recorded on the debit side in our purchases ledger control account. So I'm just going to enter that amount of 100 right here. Then the second error is that the discounts received column in the cash book had been understated by 50. Again, cash book is our prime entry, which is the basis for the purchase ledger control account. And the thing that had been understated there would also be understated in our purchases ledger control account, right? And discount received is an item that reduces the amount that we owe to our suppliers, which is recorded on the debit side. And if this had been understated, it just means that we need to add this 50 again as part of our discounts received. So we just need to enter this 50 as discount received on the debit side of our purchases ledger control account. Let's do that. Now that concludes all of our errors. So we can now figure out the new closing balance for our purchases ledger control account. So the closing balance will be on the opposite side. Now, in order to figure out this value, we need the total first. And we can figure out the total from our credit side. That is just going to be 7,270. Now this closing balance acts as a balancing figure, and whenever we're trying to figure out the balancing figure, we just need to subtract these amounts from the total. In this case, that's 7,270 minus 100 minus 50, which results in 7,120. So this is the updated amount for the purchases ledger control account balance after the corrections of the above mentioned errors. Now we just need to repeat the same process for this accounts of trade payables. We have the opening value of 6,860. Then we have the credit note, and it had been omitted from the book of prime entry, which also means that it had been omitted from any other accounts, such as the accounts of trade payables. So we need to adjust it to this value of 6,860, right? And like I said before, the credit note received from a supplier just indicates that the amount that we owe has been reduced, and the amount that we owe is basically the trade payables. So we need to reduce the value of trade payables by 100. Let's subtract the 100 now. Then the discounts received column in the cash book. Remember that this had only been understated in the cash book, which would not be reflected in our accounts of trade payables. So we do not need to adjust this second error to the total of our trade payables. So that is all. Then the new total of the accounts of trade payables is going to be 6,860 minus 100, which results in 6,760. This is the correct amount. So the answer that we're looking for will be 7,120 for the purchases ledger control account and 6,760 for our accounts of trade payables. Let's have a look at our options. We can see these two values are given in option B, so that will be the correct answer. This concludes question number 6. We can now move towards question number 7. Which group would appear only on the credit side of a sales ledger control account? The first one is cash refunds, which is always recorded on the debit side. And we're only talking about the credit side, which means that option A is incorrect. Option B also includes the cash refunds, which are always recorded on the debit side, so this is incorrect as well. Now for the third option, we're given irrecoverable debts written off, which is always recorded in the credit side of our sales ledger control account, as it reduces the amount that we will receive from the debtors, right? And then we have cash received, which again reduces the amount that we are yet to receive, which will be recorded on the credit side of our sales ledger control account. And then we have discounts allowed, which is again recorded on the credit side. So this is what we're looking for, which means that option C will be our correct answer. Let's take a look at option D as well. Irrecoverable debts is on the credit side, so that is correct. Cash refunds is on the debit side. That's why our option D is also going to be the incorrect one. This concludes question number 7. We can now move towards question number 8. As we can see, this question has been removed, so now we will move towards question number 9. A business has calculated its draft profit for the year, and the following information was then discovered. And we are asked to figure out the effect on the profit for the year when these items are adjusted. So the very first information we're given is that the closing inventory had been overvalued. So we know that closing inventory is something that we add when trying to figure out the profit for the year. And if it had been overvalued, we need to reduce its value, right? So that's a negative. And positive and a negative results in a negative, which means that our error in the closing inventory will now reduce the profit for the year. So that is a decrease, which is given in A and B. Then we have irrecoverable debts, which needed to be written off. And remember that irrecoverable debts are treated as an expense when trying to figure out our profit. So this just means that we need to reduce it. And while reducing additional expenses, our profit for the year will also decrease. And that is given in option A, option C, and option D. Now the third one we have is depreciation of non-current assets that needed to be reduced. Remember that depreciation is treated as an expense, so that is a negative when trying to figure out our profit for the year. And this amount needs to be reduced, so that is again a negative. And two negatives results in a positive, which means that this error in the depreciation will now increase our profit for the year, which is given in option A and D. So the correct options for all three, closing inventory, trade receivables, and depreciation reduction, is given in option A. That will be our answer. This concludes question number 9. We can now move towards question number 10. A business makes a provision for doubtful debts of 4%. At 31st March 2021, the value of trade receivables after deducting the provision was 153,600. For the year ended 31st March 2022, there was an increase of 960 in the provision for doubtful debts. And now we need to figure out the value of trade receivables at 31st March 2022 after deducting the provision for doubtful debts. Okay, let's start with the information that we have for the year ended 31st March 2021. We are told that the value of trade receivables, so that's trade receivables, minus the provision. And we know that the provision is basically 4% of the trade receivables. So minus 4%, which we can write down as 0.04 of trade receivables, has the value of 153,600. Now let's solve this equation and figure out the actual trade receivables value for the year ended 31st March 2021. That is 1 trade receivable minus 0.04 trade receivables. So that's 0.96 trade receivables has the value of 153,600, which means that the value of the trade receivables is just going to be 153,600 divided by 0.96, which results in an amount of 160,000. Now let's figure out the provision for 2021. That is just the 4% of trade receivables. So that's 0.04 times the trade receivables value that we just figured out to be 160,000. This results in the provision for the year ended 31st March 2021 to have the value of 6,400. Okay, then we are told that for the year ended 31st March 2022, there was an increase of 960 in the provision for doubtful debts. This just means that the provision for the year 2022 is 960 greater than that for the provision for 2021. So the provision for 2022 is just going to be last year's provision of 6,400 plus 960, which results in the value of 7,360. Now, we need to figure out the value of trade receivables, and the relationship between the trade receivables and provision for doubtful debts is that 4% of trade receivables is the provision. So we already have the provision amount. And from this, we can figure out our trade receivables value. That is just 4% of trade receivables is the provision amount, which is 7,360 for the year ended 31st March 2022. Which means that the value for trade receivables is 7,360 divided by 0.04, which results in the value of 184,000. And we're being asked to figure out the value of trade receivables at 31st March 2022 after deducting the provision. So we have our total trade receivables to be 184,000. And the provision for the year ended 31st March 2022 was 7,360. So the answer that we actually require is going to be 176,640, which is given in option C. So that will be our correct answer. This concludes question number 10. We can now move towards question number 11. When preparing a sole trader's financial statements, no adjustment was made for a prepayment at the end of the year. What is the effect of this omission? So prepayment just means an expense for the next financial period, but we treated it as an expense for this year, which means that our total expenses had been overstated, right? And if we have already paid for the expenses for next year, but have not received the benefits for those corresponding expenses, this just means that prepayment is also a receivable, and receivables are included in our current assets, but we did not adjust it, which means that our current asset is now being undervalued. And we are given capital as well. So let's talk about the effect on capital. And since our expenses are more than it should have been, our profit will be decreased, right? Profit will be understated. And remember that profits are always added to the capital. And if the amount to be added is now decreased or understated, this just means that the owner's capital will also be understated, right? So we're looking for current assets understated and owner's capital understated, which is given in option B. That will be the correct answer. This concludes question number 11. We can now move towards question number 12. A sole trader has not kept proper accounting records for his first year of trading, and we're given the following information. We need to figure out the profit for the year. Okay, so these are the cash from customers, which are the amount that we received for the goods sold. So these are the sales revenue, which should be added when trying to figure out the profit, right? So this is a plus. Then we have trade receivables. And remember that trade receivables is the amount that we are yet to receive for the credit sales made. And since this is the first year of trading, the entire trade receivables value corresponds to this year, which means that we need to add this value of credit sales while figuring out the profit for the year as well. So that's a plus. Then we have cash paid to suppliers. So these are the payments made to suppliers for the goods that we purchased, which is an expense. So this should be deducted when trying to figure out our profit. Then we have trade payables. Again, trade payables is the amount that arises after making a credit purchase. And since this is our first year of trading, this entire value of the trade payables relates to this year's credit purchases. And no matter whether it is a cash or credit, purchases should always be deducted. So I'm just going to subtract this value of 2,000. Then we have our closing inventory. Closing inventory should always be added when trying to figure out the profit. So that's a plus. And the expenses paid, which needs to be subtracted. So that's a negative. Now the total profit for the year is going to be 70,000 plus 4,000 minus 65,000 minus 2,000 plus 20,000 minus 3,000, which results in the value of 24,000. This is the answer we're looking for, which is given in option A. This concludes question number 12. We can now move towards question number 13. On 1st January 2022, a sole trader's inventory was valued at 4,500. On 14 April 2022, there was a fire in his business premises. Up to 14 April 2022, his sales were 24,600 and his purchases were 16,700. So here we're talking about two dates. The starting or the opening date is 1st January 2022 and the closing date is 14 April 2022. And in between these periods, the sales were of 24,600 and the purchases were of 16,700. He worked on a markup of 33.33%, which is basically 1 by 3. And the relationship of markup is that cost of sales plus the markup percentage of cost of sales, which in this case is 1 by 3. So that's 1 by 3 of cost of sales will result in revenue. In this case, we have the total revenue to be 24,600, right? So that's cost of sales times 1 plus 1 by 3 equals to the revenue value of 24,600 Let's figure out the cost of sales. That will be cost of sales equals to 24,600 divided by 1 plus 1 by 3, which is 4 by 3. This results in the value of cost of sales to be 18,450. Now, goods which had cost 1,485 were saved from the fire because we were told that on 14 April 2022 there was a fire in his business premises, and this included some goods which had cost 800, but as a result of the fire damage can now only be sold for 650. So let's adjust this closing inventory value of 1,485. So previously it had that value, but this also included some goods which had cost 800 and it was damaged, right? So the damaged value should always be subtracted from our closing inventory. So I'm just going to subtract the 800, and it can now be only sold for 650. So those damaged goods can still be sold, and its value should be included in our closing inventory, right? The value at which it should be included is its sales value. So that's plus 650. Now this gives the new value of closing inventory to be 1,335. Now we need to figure out the total inventory loss for the business. Remember that these are only the closing inventory value that were saved from the fire. Now we need to figure out the value that were lost to the fire. For this, we first need to figure out the total value of the closing inventory, and we can do so from our cost of sales. Let's write down the formula for cost of sales, that is opening inventory plus purchase minus closing inventory, right? And it has a value of 18,450. Now let's substitute the values for opening inventory and purchases. We can see that our opening date of 1st January 2022, the inventory was valued at 4,500. So that will be our opening inventory. Then we are also given the value for purchases, and it was 16,700 minus the closing inventory, that is 18,450. Now we can easily solve this equation and figure out the value for closing inventory. That will be 4,500 plus 16,700 minus 18,450. This results in the value of 2,750. So this was the total value, and from this we only saved the inventory worth 1,335, which means that the remaining value is the total inventory loss. Let's figure it out. That's 2,750 minus 1,335, which results in the value of 1,415. This is the value or the answer that we're looking for, which is given in option C. This concludes question number 13. We can now move towards question number 14. We need to figure out which items would appear on the debit side of the dissolution account for a partnership. The first one is cost of dissolution. That is true because it is always recorded on the debit side of the dissolution account. The second one is net book value of the assets, which is again true. This is always recorded on the debit side of the dissolution account. The third one is proceeds of sales of assets. Remember, if we are recording the net book value of the assets on the debit side, this just means that the proceeds of sales of those assets will be recorded on the credit side. So this is incorrect. And the fourth one we have is profit on dissolution, which is to be recorded on the debit side. So the correct items are 1, 2, and 4, which is given in option B. That will be the correct answer. This concludes question number 14. We can now move towards question number 15. L and M were in partnership, sharing profits and losses equally. They admitted a new partner, P. The partners do not have a partnership agreement, and the terms of P's admission were as follows. Assets were revalued downwards by 60,000. So this is a loss on revaluation, which is to be shared by the existing partners L and M equally. And then the goodwill was valued at 30,000 but was not retained in the books of accounts. We now need to figure out the effect on L's capital account balance on the admission of P. So the effect due to revaluation is that we already figured out it is a loss on revaluation, which will deduct the capital account balance, right? So that is a decrement, which is given in A and B. And then we have effect due to goodwill. So let's just record the goodwill only for L's capital account. We know that the goodwill based on previous profit sharing ratio is to be recorded on the debit side of the capital account. And we can see that the goodwill was valued at 30,000. If we look at the previous profit sharing ratio, that is shared equally among two partners, right? So for L, he's going to get 30,000 by 2, which is 15,000. Then the goodwill value based on the new profit sharing ratio is to be recorded on the credit side. Now a new partner is there, which means that this goodwill value will now be shared equally among the three partners. And we're sharing it equally because they did not have any sort of partnership agreement, which means that the profit sharing ratio is on an equal basis. So now the new goodwill is 30,000 by 3, which results in 10,000. And we can see that the credit side is heavier, and we're talking about capital account. So a heavier credit side means that there has been an increase in the capital account. The effect due to goodwill is an increment given in A and C, and the correct one for both revaluation and goodwill is given by option A, so that will be the correct answer. This concludes question number 15. We can now move towards question number 16. J and K are in partnership, sharing residual profits and losses in the ratio 7:3. Their fixed capital accounts have balances of 40,000 and 60,000, and interest is allowed on these at the rate of 10% per year. Let's figure out the interest on capital. For J, that will be the capital amount of 40,000 times the interest rate of 10%, which you can write down as 0.10, which results in the value of 4,000. And for K, that will be the capital amount of 60,000 times the rate of 10%, which results in the amount of 6,000. Okay, then J is paid a salary of 40,000 per year, and the profit for the year was 200,000. We now need to figure out each partner's total share of the profit. And remember that we're not just talking about the residual share of profit, but the total share of profit, which means that we also need to add the salary and the interest on capital that they will receive. Okay, so the first thing that we need to figure out will be the residual share of profit, and for that we will prepare our appropriation account. We're going to start with the profit for the year, which is given to be 200,000. And we're also given the information regarding interest on capital. And interest on capital is something that the partnership gives to the partners for their capital provided, right? Which means that this is going to reduce the profit. So that's minus interest on capital. For J, that was 4,000. So we need to reduce 4,000. And for K, it was 6,000. Then we're also told that J is paid a salary of 40,000, which will again reduce the residual profit. So that's minus salary of 40,000. And this is everything to be included in our appropriation account. So now we can figure out the residual profit. That is the sum of these four amounts. That's 200,000 minus 4,000 minus 6,000 minus 40,000, which results in 150,000. We now need to divide this residual profit among the partners, J and K. So for J, that's a total of 150,000. And the profit sharing ratio is 7 parts out of 10 parts belongs to J. So that's times 7 by 10, which results in the amount of 105,000. Now we repeat the same process for K. That will be the total amount of 150,000. And the profit sharing ratio is 3 parts out of 10 parts for K. So that's 3 by 10, which results in the amount of 45,000. But we need to figure out the total share of profit. So let's figure it out for J. We'll start with our residual profit of 105,000. Then J is also receiving the salary of 40,000. And he's also receiving interest on capital of 4,000. So that's plus 4,000. Now the total share of profit for J is going to be 105,000 plus 40,000 plus 4,000, which is 149,000. Now we repeat the same process for K. We'll start with the residual profit of 45,000. And K receives interest on capital, that is of 6,000. So the total share of profit for K is going to be 51,000. The correct answer we're looking for is 149,000 for J and 51,000 for K, which is given in option C. This concludes question number 16. We can now move towards question number 17. X, Y, and Z were in partnership sharing profits and losses equally. Z retired from the partnership on 31st March 2022. The balances on his capital account and current account were 85,000 and 7,000 debit, respectively. After Z's retirement, X and Y would share profits and losses equally. Goodwill was valued at 24,000 and would not remain in the books of accounts. As part of the amount due to him, Z took a motor vehicle at an agreed valuation of 4,000, and the other non-current assets were revalued downwards. So this is a loss on revaluation of 15,000. The remaining amount due to Z would be paid equally by X and Y. And we just need to figure out how much amount X would pay to Z. So first of all, we need to figure out this remaining amount due to Z. We can figure it out by preparing the capital account for Z. Let's do that. We start with our opening balance, which is given to be 85,000 for Z, and the opening balances for capital account will always be recorded on the credit side. And since Z is now retiring, we also need to adjust his current account balance, right? And the current account balance is given to be 7,000, but debit, which means that this amount of 7,000 should be recorded on the debit side in his capital account. All right, then the next thing we have is our goodwill valuation. And we know that the profit sharing ratio is on an equal basis. So we just need to divide this goodwill among the 3 partners equally. That will be 24,000 divided by 3, which results in the amount of 8,000. And the goodwill is to be recorded on the credit side since it increases the capital account balance for Z. The next thing we have is that Z took a motor vehicle. So while he takes this motor vehicle with the value 4,000, he also needs to repay this value to the partnership, right? So that would reduce his capital account balance, and the reduction in capital account balances are always to be recorded on the debit side, which means that this amount of 4,000 will also be on the debit side. Then we have loss on revaluation. Again, losses always reduces the capital account balances, so this loss should also be recorded on the debit side in Z's capital account. And again, this loss is to be divided among the 3 partners equally. That's going to be 15,000 by 3, which results in 5,000. This should be recorded on the debit side. Okay, this concludes everything. Now we can figure out the remaining balance. In order to figure it out, we first need to figure out the total, which we can figure out by adding these amounts in the credit side. That's 85,000 plus 8,000, which results in 93,000. Now this balance acts as the balancing figure, and whenever we're trying to figure out the balancing figure, we just need to subtract these amounts from the total. In this case, that's 93,000 minus 7,000 minus 4,000 minus 5,000, which results in 77,000. And we're only trying to figure out the amount that X would pay to Z, which is half of the balance due to him, right? So that will be the total balance of 77,000 divided by 2, which results in the amount of 38,500. This is the answer we're looking for, which is given in option C. This concludes question number 17. We can now move towards question number 18. Draft financial statements for a company showed a balance of retained earnings of 170,000 at the year end. Then the following information was discovered. We now need to figure out the correct balance of retained earnings. Let's start with our draft amount of 170,000. Then an irrecoverable debt of 25,000 should have been written off. Irrecoverable debt is treated as an expense, which should be subtracted when trying to figure out the profit for the year, right? And the profit for the year is always added to our retained earnings. So that's a negative and a positive, which results in a negative, which just means that in order to rectify this error, we need to subtract this amount of 25,000 from our draft balance of the retained earnings. So that's minus 25,000. Then an ordinary share dividend 30,000 had been paid but not recorded, and the dividends paid are always subtracted from our retained earnings, so we also need to subtract this amount of 30,000. And the last one we have is the closing inventory value, which was undervalued by 15,000. And remember that closing inventory is something that we add in order to figure out the profit for the year. If it had been undervalued, we just need to add its value back, right? So that's another positive. And then the profit for the year is always added to the retained earnings. So that's another positive. So 3 positives again results in a positive, which just means that in order to rectify this error, we need to add this amount of 15,000 back to the balance of retained earnings. So that's plus 15,000. Now the correct balance of retained earnings at the year end is going to be 170,000 minus 25,000 minus 30,000 plus 15,000, which results in 130,000. This is the answer we're looking for, which is given in option C. This concludes question number 18. We can now move towards question number 19. A company provided the following information. Where given the ordinary shares and retained earnings balance at 1st January, then the following actions took place during the year ended 31st December. Okay, let's have a look at our question. We now need to figure out the total shareholders' equity at 31st December. Let's start with the total equity at 1st January. That's 100,000 plus 95,000 Then, a bonus issue of 1 ordinary share for every 2 ordinary shares held on 1st January. Remember that bonus issue is funded by our reserves and it does not make any difference on the total equity, so we do not need to adjust it at all. The second one we have is a rights issue of 50,000 ordinary shares at 1.25 each, and the issue was fully subscribed. So this rights issue obviously increases the value of our total equity. So let's figure out its value. That's the number of shares, 50,000, times the amount at which it was issued, which was 1.25. This gives the total value for the rights issue to be 62,500, and this needs to be added. Then we have a transfer of 25,000 to create a general reserve. And a transfer basically means that we're subtracting 25,000 from the retained earnings and adding it to the general reserve. So overall, in our total equity, this does not make any change. So we do not need to adjust it. Then the fourth one we have is a dividend of 11,250 was paid. And dividend paid always reduces our retained earnings, which means that it is also going to reduce our total shareholders' equity. So we need to subtract this amount of 11,250. Then we're given the profit for the year to be 68,500, which always needs to be added to the retained earnings, which means that this amount of 68,500 will also increase the total shareholders' equity. So that's plus 68,500. The total shareholders' equity is going to be 100,000 plus 95,000 plus 62,500 minus 11,250 plus 68,500, which results in the amount of 314,750. This is the answer we're looking for, which is given in option B. This concludes question number 19. We can now move towards question number 20. A business buys goods for resale, paying by check rather than buying on credit. We need to figure out the effect this will have on the current ratio and the liquid or acid test ratio. So let's recall the formula for a current ratio. That is just the current assets divided by current liabilities. And we are buying goods for resale, which means that our inventory is being increased. And we are paying it by check, which means that our bank balance is being decreased by the same amount. So overall, our current assets is not going to have any sort of change. And if both of these factors are not going to change at all, that means that our current ratio is also going to remain unchanged. So that's no change given by C and D. And then we also need to talk about our acid test ratio. So the liquid ratio has the formula current assets minus inventory divided by current liabilities. And we've already figured out that our inventory is being increased. And whenever the negative aspect of any formula is being increased, this total value is going to decrease. And if the numerator of any formula decreases, the total value will also decrease. So this just means that our liquid ratio is going to be decreased, which is given by A, B, and C. So the correct one for both current ratio and liquid ratio is given by option C. That is going to be the correct answer. This concludes question number 20. We can now move towards question number 21. The following information is available, and we need to figure out the non-current asset turnover in times. The formula for non-current asset turnover is net sales divided by non-current assets at net book value. Let's write down the value for sales. We can see the sales revenue is given right here to be 980,000. Now we just need to figure out the non-current assets value, and its value at cost is given as well as its provision for depreciation is given. And remember, we need to include it at its net book value. And the net book value is just the difference between cost and provision for depreciation. So net book value, it will be the cost of 400,000 minus our provision for depreciation of 280,000. This gives the value of 120,000. Let's substitute this in our formula. Now our non-current asset turnover in times is going to be 980,000 divided by 120,000, which results in 8.17, which is given in option D. This concludes question number 21. We can now move towards question number 22. A cost accountant is calculating the budgeted production overheads for a company which makes and sells a single product. We need to figure out which row will give the correct total of production overheads. And remember, we're talking about overheads, which means that we're only looking for factory overheads and not the direct costs. Okay, the first one we have is wages of production workers. So production workers' wages is basically the direct labor, which means that it is a part of direct cost which should not be included in our production overheads. Then we have wages of assembly workers. Again, these are the direct labor which will not be included as part of our production overhead. Then we have supervisors' salaries, which is not a direct cost. So this will be included as part of our production overhead. Then we have wages of factory maintenance workers. Remember that these are not the workers working on our products, but these are the workers working to maintain the factory, which should be included in the production overheads. Then we have cost of raw materials, which is a direct cost. This should not be included. Then we have cost of factory cleaning materials. These are again the production overheads. So the correct ones will be supervisor salaries, wages of factory maintenance workers, and cost of factory cleaning materials. And we can see that these three are given in option D. So that's going to be the correct answer. This concludes question number 22. We can now move towards question number 23. Workers are paid a basic rate of 10 per hour. Overtime rate is paid at time and a half. So the overtime rate is the basic rate of 10 plus the half of it. So that's 10 by 2, which is 10 plus 5. That's 15 per hour. Alright, then the bonus is paid at a rate of 10% of basic pay if production exceeds its target. Let's have a look at the given information. We can see that the basic rate hours is 1000 hours, which means that the total basic pay is going to be the number of basic hours, which is 1000, times the basic rate per hour, which is 10. So the total basic pay is going to be 10,000, and the bonus is just 10% of this basic pay. So that's going to be 10,000 times 10%, which we can write down as 0.10, which results in an amount of 1000. And this amount of 1000 is to be paid when the production exceeds its target, and the target is 12,500. Alright, now we just need to figure out the total factory labor cost for the month. We are told that the total hours worked is 1500. So for the 1000 hours, they will be getting the basic rate of 10 per hour. Then we have additional 500, right? So for those extra 500, they'll be getting the overtime rate of 15 per hour. And we can also see that the actual production is 15,000, which is greater than the target production. And if the production exceeds its target, we need to pay the bonus of 1000. So that's another 1000. Alright, so the total factory labor cost for the month is going to be 1000 times 10 plus 500 times 15 plus 1000, which results in the value of 18,500. This is the correct answer, which is given in option B. This concludes question number 23. We can now move towards question number 24. Why are service department costs transferred to production departments? The first reason is so that both direct and indirect costs can be covered by revenue. That is very true because service department costs can be treated as indirect since it is not directly involved with the production of goods. The second one is so that overhead absorption rates can be calculated and applied. This is also true because if we remember our absorption costing, we used to apportion the cost of service department to our production departments and then figure out the overhead absorption rates, right? And the third one is so that the break-even point can be calculated. So break-even point cannot be calculated by transferring the service department cost to production department because it follows marginal costing where we clearly identify our variable cost and the fixed cost. So this is incorrect. The correct ones are 1 and 2, which is given in option A. This concludes question number 24. We can now move towards question number 25. A company's profit was 100,000 using marginal costing. Its opening inventory was 2,000 units and the closing inventory was 3,000 units. The fixed production overhead absorption rate is 30 per unit. We now need to figure out the profit using absorption costing. Okay, let's talk about profit using marginal costing. That is just the contribution per unit times the total number of units minus fixed cost. Right? This gives the profit of 100,000. Now let's talk about the profit using absorption costing. Under absorption costing, again, the contribution factor is the same. So that's contribution times unit. And remember that the fixed cost is apportioned to all of the units, which also includes the closing inventory units, right? So that is just going to be minus our opening inventory of 2,000 plus the units produced in this month, that's U. And then we subtract our closing inventory, that's 3,000 units. And then we multiply it with the rate per unit, which is the production overhead absorption rate per unit given to be 30. That's basically the fixed cost, right? This is what we're trying to figure out. Let's open the bracket. That's C times U minus 2000 minus 3000 is going to be minus 1000 times 30. That's C times U minus U times 30 plus 1000 times 30. And remember, this is the unit produced and this is the production overhead absorption rate, which basically gives our total fixed cost, right? So let's replace it. That's minus fixed cost plus 1000 times 30. And we can see that contribution times unit minus fixed cost has a value of 100,000. So we can just replace its value by 100,000. Plus 1000 times 30 is 30,000. So the profit using absorption costing is 100,000 plus 30,000, which is 130,000. This is the answer we're looking for, which is given in option C. So what we can conclude is that the profit under absorption costing will be higher if there is a higher closing inventory. Okay, this concludes question number 25. We can now move towards question number 26. A business prepares its income statement using marginal costing. The profit is reduced by changing from marginal costing to absorption costing. Okay, similar to the previous question, we can see that when there was an increment or a higher closing inventory value, our profit increased, which means if there were to be a lower value of closing inventory, the profit using absorption costing will be lower as compared to the profit using marginal costing. So that is the very same concept we will be applying in question number 26. Let's look at our statements. The first one is that all units produced in the period were sold. If that is the case, then the profit under marginal costing will be equal to that of absorption costing. And we're not looking for that. So this is incorrect. The second one is units sold were greater than units produced. So this just means that there were some opening inventory and the units produced in this month that were sold. And both the opening inventory and units produced in this month will be subtracted in order to figure out the profit under absorption costing, which means that the greater opening inventory shows a higher expense, and a higher expense always results in a lower profit, and that is exactly what we're looking for. So option B is the correct one. Let's have a look at the remaining options as well. Units sold were fewer than units produced. This just means that we have remaining closing inventory, and a higher closing inventory results in a higher profit under absorption costing, but that is not the case we're looking for, so this is incorrect. And the final one we have is there were no units produced in the period, which means that the entire unit sold will be sustained by our opening inventory, and minus opening inventory is lower than our minus opening inventory as well as the units produced in this month. So again, the correct answer is still going to be option B. This concludes question number 26. We can now move towards question number 27. A company wants to sell 50,000 units and achieve a profit of 600,000. It has variable cost of 60 per unit and total fixed overheads of 400,000. We now need to figure out the selling price per unit it needs to charge to achieve the required profit. Okay, so we can just create an equation. So the equation in order to figure out the profit will be the total number of units times the contribution per unit minus fixed cost. It will result in the profit. And we are given the number of units to be 50,000. Contribution is just the difference between selling price and variable cost, and selling price is what we're trying to figure out. Minus the variable cost per unit is 60. And we're given the fixed overheads to be 400,000. And this equals the profit of 600,000. Okay. Let's solve this equation. That is just going to be 50,000 times selling price minus 60 equals to 600,000 plus 400,000. This means selling price minus 60 equals to 1 million divided by 50,000. That selling price minus 60 equals to 20. Which means that our selling price per unit is 20 plus 60, which results in the value of 80. This is the answer we're looking for, which is given in option D. This concludes question number 27. We can now move towards question number 28. The following information is available for a month. We're given the sales revenue, total cost, and the variable overheads, which is also included in this total cost. When calculating the contribution to sales ratio, the bookkeeper treated the variable overheads as fixed by mistake. What was the effect of this on the contribution to sales ratio? Let's figure out the actual contribution to sales ratio. And the formula is just contribution by sales times 100%, right? And contribution is the difference between sales revenue and variable cost. In this case, our sales revenue is 160,000 minus the variable cost is 26,000 divided by the sales revenue of 160,000 times 100%. So this gives the actual contribution to sales ratio to have the value of 83.75%. Now let's talk about what the bookkeeper did. He treated the variable overheads as fixed, which means that this was also considered to be fixed, so variable cost was basically zero. Now the contribution to sales ratio according to this value will be our sales revenue of 160,000 minus the variable cost, which is zero in this case, divided by the sales value of 160,000 times 100%, and this gives our contribution to sales ratio to have the value of 100%. So we can clearly see that the effect was that it was higher than it was supposed to be, right? Let's figure out the higher value, that's 100%, minus the actual value of 83.75%, which is 16.25%. So the contribution to sales ratio is 16.25% higher than its actual value. And this answer is given in option A. This concludes question number 28. We can now move towards question number 29. A business had the following results in April and May. We are given the units produced and sold, total revenue, total contribution, total profit. The selling price per unit and the total fixed cost remain constant. We need to figure out the change in the variable cost per unit. First of all, let's figure out the selling price per unit utilizing our total revenue and the total units sold for the month of April. So selling price per unit is the total revenue, which is given to be 50,000, divided by the number of units, which is 1,000. This gives the value of 50. Then we have the total revenue and total contribution, from which we can figure out the total variable cost, because the relationship is that revenue minus variable cost is contribution, right? The revenue we have is 50,000 minus variable cost, and the contribution we have is 22,000. So our total variable cost is going to be 50,000 minus 22,000, which results in the value of 28,000. Now we can figure out the variable cost per unit. And remember that this is for the month of April. That's the total variable cost of 28,000 divided by the number of units for April, that's 1,000, which results in the value of 28. Now we're also told that the total fixed cost remained constant. Let's figure out the fixed cost. That is just the total contribution minus fixed cost results in total profit. So let's substitute the value. We have the total contribution of 22,000. We need to figure out the fixed cost, and we're given the total profit to be of 8,000, which means that our fixed cost is going to be 22,000 minus 8,000, which results in the value of 14,000. Now let's talk about the contribution for the month of May. We are given the profit. We know that the fixed cost is going to remain constant, so we can easily figure out the contribution. That's total contribution minus fixed cost equals to profit. We're trying to figure out the total contribution. Our fixed cost is going to remain constant at 14,000, and our profit is given to be 10,500. This just means that our total contribution is going to be 10,500 plus 14,000. This results in our total contribution to have the value of 24,500. Now we can figure out the contribution per unit for the month of May. That's the total value of 24,500 divided by the number of units for May, which is 1,200. This results in the value of 20.42. And from the contribution per unit and our sales price per unit, we can now figure out the variable cost per unit for the month of May. That is just the difference between these two. So that's selling price of 50 minus the contribution of 20.42. This gives the value of 29.58. As compared to the month of April, the variable cost per unit has now increased, right? So let's figure out this increment amount. That is just the difference For the month of May, that's 29.58. And for the previous month of April, that was 28. So the increase is of 1.58. This is the change in the variable cost. And the increase of 1.58 is given in option D. That will be our correct answer. This concludes question number 29. We can now move towards question number 30. We need to figure out which statements about budgeting are correct. The first one is that accurate overhead allocations are always made. This is incorrect because we are basically just predicting the future, and it cannot be always accurate, right? The second one is managers may make budgets easy to achieve. This is true because they could show to their directors that they have been achieving their budgeted targets, right? This can be correct. Then the third one is financial factors are considered. This is very true because budgeting is all about our quantities. And the fourth one is very little time is taken to produce the budget. That is actually untrue because budget needs to be as accurate as possible, which requires a lot of time, right? So the only correct statements are 2 and 3, which is given in option C. That will be the correct answer. This concludes question number 30 as well as this entire paper 1-3 of 2022 October and November session. If you found this video useful, make sure you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.